Hello, I'm Tab here from class E4, and in this video I'll be presenting my digital banking and fintech ICA1 video. So first of all, in this video I'll be going through the MAS's decision to allow up to 5 digital banking licenses, followed by what is a sustainable digital banking business model, the implications of not possessing a sustainable banking business model, influence on Singapore's financial services industry in the near and long term in comparison to Hong Kong, what is a very destructive competition, and I'll end it off the conclusion. So following the announcement and issuing of Hong Kong's virtual banking license, Singapore has announced their intentions to do the same and launch up to 5 digital bank licenses. So first of all, what is a digital bank? Well, a digital bank generally refers to banking entities that offer banking services such as deposits, loans, debit and credit cards, like a traditional bank, except that the transactions are performed online without a physical branch. These banks have the ability to reach a wider segment of customers, lower costs, and the potential to automate much of the blockages slowing down a typical banking operation. Singapore's decision to open doors to digital-only bank comes close on the heels of the Hong Kong Monetary Authority, who has issued 8 digital banking licenses this year. This new regime promises to strengthen Singapore's banking sector with innovative business models and strong digital capabilities, while ensuring it stays resilient, competitive, and vibrant in the digital future. The focus is on the undeserved or unbanked market segments, for example SMEs and millennials, as well as providing further impetus for existing banks to accelerate the innovation of their digital offerings. So, MAS specified that the organization or its parent company that applies for the digital banking license must demonstrate a sustainable digital banking business model, which brings us to a second point. What does its sustainable digital banking business model mean? So a true sustainable digital bank business model means that the bank optimizes its customer interactions, products, processes, and data around digital technologies. A sustainable business model should consist of a good business strategy, where it is essential to clearly identify target customers and strike a fine balance between the desire to build market share and the need to earn a reasonable return on asset and equity. Digital banks should also show technological innovation in their sustainable business model. They need to embark on a technological innovation journey, as the source of innovation will be a critical factor to increase market share and its competitiveness. Like conventional banks, a digital bank applicant must understand the type of risk to which it is exposed and must put in place appropriate systems to identify, measure, monitor, and control them. They should also be aware that certain types of risks such as liquidity, operational, including protection of customer data, and reputation must be further emphasized in the case of digital banks because of the nature of operation. Lastly, capital strength and commitment are vital in the operation of a digital bank. Digital banks must maintain adequate capital with the nature of their operations and the banking risk they are undertaking. A background check of the controllers, directors, and chief executives of the digital bank is a must. Now moving on to our third point, what are the possible implications if a digital bank does not possess a sustainable digital banking business model? First of all, they will be exposed to digital compliance and cybersecurity risks. Banks operating in a digital environment must still comply with all applicable laws and regulations. This includes paying particular attention to uniquely digital processes that are covered under specific rules, such as electronically signing documents per the e-Sign Act. Furthermore, as most transactions are online, banks and consumers are even more exposed to cybersecurity risks such as malware and data manipulation. Another risk that will arise is from third-party risk management. Many banks are outsourcing all or part of their digital strategy to fintechs and other third-party vendors. Inappropriate use of information by these third-party vendors will result in a breach of privacy and spoil the bank's reputation. Lastly, failure of not possessing a sustainable business model can result in fraud and identity theft, as more banking without face-to-face interaction can increase the risk of synthetic identity fraud, traditional identity theft, and account takeovers. Now, moving on to our fourth point. What is the influence on the near and long-term futures of the financial services industry in Singapore in relation to its competitor Hong Kong? So according to a JD Power survey, Hong Kong is significantly underbanked as far as mobile banking is concerned. Only 30% of Hong Kongers interacted with their banks through mobile phones, compared to 41% in Singapore. The fact that Hong Kong is underbanked as far as mobile banking is concerned is the reason the government believes that virtual banks can make inroads into the Hong Kong banking market with niche products. Also, according to the same survey, close to one-third of Hong Kongers are considering switching their main bank account to a digital account compared to around one-fifth of Singaporeans. However, in Hong Kong, the licensed banks control virtually 99.3% of total loans, two-thirds of retail banking, and three-fourths of mortgages and credit cards. So, is there really space for 8 virtual banks? Another challenge for Hong Kong virtual bank operators is the fact that millennials in the region prefer a combination of high technology integration in their banking experience with a high touch experience, which will mean higher cost and investment in more human resources for on-demand interaction. On the other hand, in Singapore, MS does not want consistently loss-making technology or e-commerce companies to apply for a license. Also, it is interesting to note that Singapore does not want virtual banking innovation in a way that de-establishes the existing bank's businesses. This is also probably the reason why MAS has limited the number of licenses given out. This shows that MAS supports innovation while seeking to achieve a level playing field among the players, which is why capital requirement and the end stage for virtual banking license is the same. Given the eventual capital requirement of 1.5 billion, the MAS is ensuring that only the financially strongest of the technology companies will apply for the licenses. However, the high capital requirement also causes Singaporean virtual banks to face a high entry barrier, making it more difficult for virtual banks to compete in Singapore's banking landscape. Nevertheless, the strong regulatory support from MAS, virtual banks should add value to the fintech ecosystem, said Grace Chong of Counsel at Simmons & Simmons. And as for the consumers, digital-only banks will bring in more choice and elevate the banking experience by making it more easy and seamless. We may look forward to more end-to-end customer journey experiences from retailers, travel companies, and other service providers. Singapore's move to welcome digital-only banks will create new job opportunities. At the same time, the new players' hunt for talent will drive a potential churn within the industry. The move will also raise the capabilities of Singapore's SMEs by helping them adopt digital services. Now, the MAS also stated that it will not allow any bank digital node to engage in value-destructive competition to gain market share. So what is value-destructive competition? Well, value-destructive competition here means when an established sector that has a lot of value is replaced and loses value due to unsustainable banking practices by another bank. An example is when the entry and popularity of ride-hailing such as Grab destroyed the value of the taxi industry. So why is value-destructive competition harmful in Singapore's financial landscape? Well, if a bank were to engage in value-destructive competition, the affected bank will be replaced and lose value. The affected bank's assets prices will rapidly decline in value and will experience liquidity shortages. Investors will sell off assets and withdraw money from savings accounts as they fear the value of assets will drop. This will result in a financial crisis which could spread throughout a single economy and even economies in the region. Hence, the MAS will focus on companies that add value to the existing ecosystem rather than disruptors, as they do not want to compromise the anchoring positions of local banks which hold a significant market share overall. The goal is to keep systemic balances in check. Now, we are coming to an end to this video. So in conclusion, issuance of the 5 digital bank licenses will help to strengthen Singapore's banking sector with innovative business models and strong digital capabilities, while ensuring it stays resilient, competitive, and vibrant in the digital future. A sustainable digital business model should consist of a good business strategy, technological innovation journey, appropriate risk control, and capital strength. Non-compliance of a sustainable business model will result in cybersecurity risks and fraud and identity theft. 8 digital banks might be too many in Hong Kong, considering most virtual transactions are controlled by the current licensed banks. Even though it's more difficult for virtual banks to compete in Singapore's banking landscape, the strong regulatory support from MAS should add value to the fintech ecosystem. Lastly, MAS will ensure digital banks will not engage in value-destructive competition by achieving a level playing field and focus on companies that add value to the existing ecosystem. That's all for this presentation.